Hello friends, now we are going to take one important segment of the chapter business valuation, where we are going to deal with some special cases. Like for example, we are going to deal with valuation of non-going companies, valuation of distressed companies, valuation of startup companies, valuation of digital platforms, valuation of professional and consultancy firms. This segment has been added in the new scheme. It was not there in the old scheme. Hence, it is important for you to prepare this segment quite well. For the time being, the institute has not given numerical questions on these topics like startup valuation, digital platform valuation, distressed company valuation. So that is something really interesting, that you don't have numerical questions on this in the study material, but I believe that as we'll go forward, the institute will design questions on this topic and they will ask you. So in future, you have to keep an eye on the RTP, MTP study material again if they revise exam paper where numerical questions on this topic can be asked, and you need to practice those topics. Okay, so here we go. We will try to understand the theoretical part, the conceptual part, and keep ourselves ready for not only theory question but also for numerical question if asked. So the scope of the work in the coming few hours, maybe 2 or 3 hours, would be to understand the valuation of going concern and non-going concern valuation. Really speaking, going concern, what we have been doing so far was based on the assumption that the entity is a going concern, and that is why we have applied discounted cash flow model and other valuation models assuming going concern. But there is a possibility company may not be a going concern. What is a non-going concern? Company is likely to get wound up, company is likely to get liquidated, or company has gone into liquidation process. Then how do I value that company? In that case, we can't apply a DCF model, future earning profit model, etc. Then we'll have to apply some other way to arrive at the valuation. Then there are companies which are called distressed company, that is their revenue is declining, profit is declining, or it is into losses, or they have huge debt burden and they are not able to pay debt, they are not able to pay interest, they have a huge fixed cost in their total operating cost, they have a huge fixed cost compared to the revenue, and they are not able to recover their fixed cost. So high operating leverage, high financial leverage, high level of borrowing, high level of fixed cost, revenue is declining, profit is declining, or profit is negative. Those are the symbols of, signs of, symptoms of a distressed company. So we have to really think whether a distressed company can be survived or will it be wound up, and accordingly the valuation will be done. Then, as you know, last few years there is a boom in the startup businesses. People are coming out with ideas, they are presenting these ideas to the investors, the venture capitalists, the angel investor, and then those companies are getting valued. Some of them are getting huge valuation, they get valuation of crores of rupees. Some of them become unicorn also, their valuation is 1000 crore. Is it right? So then how do these startups are valued? That is always a question mark, because they don't have profit, they don't have positive cash flow, they don't have too many assets, they have only an idea, they have only a story that in future this business model will succeed and in future this business will generate profit, sales, cash flow, etc. You have to sell the idea, and then there is a valuation of that idea, right? That is startup companies, and some of them get huge valuation also. Then we have to discuss digital platforms. Again, internet is now as useful, important, necessary thing as your air, water and food now. More and more businesses are shifting to digital platform. Even our education right now that you are getting is using digital platform only. You are buying groceries also on digital platform now. You are buying clothes, shoes, you are booking your tickets, you are doing search. Okay, so the life is now revolving around digital platforms. How are these to be valued? Some of them are hugely successful, like for example YouTube, your favorite, or Amazon, or Book My Show. These are digital platforms. Flipkart, Yatra, Make My Trip, iBibo or Go iBibo, whatever. How are these valued? Don't you think interesting story? And then how your CA firm, consultancy firm, legal firm will be valued. So this is my scope of work for the next few hours. Kindly pay attention. First paragraph, going concern and non-going concern. So as you understand, going concern means the entity will continue its operations for a foreseeable future. There is no need to liquidate the operation, there is no need to reduce the scale of operation. But there can be situation where going concern is doubtful. That means it is not possible that this company will go beyond 12 months. It is felt by the management that now the company can be wound up within 12 months. It is not going to continue its operation for more than 12 months. So that is called non-going concern. These terms are used mostly in accountancy literature, right? Then whether the valuation method, valuation technique will get affected because of that, the answer is yes. The valuation of asset or business will be affected depending upon assumption about the entity's ability to continue. If it is going concern, I will think about methods like DCF model, okay, capitalization of earning, intrinsic value model, growth model. All this will be kept in mind. But when the entity is no longer a going concern, I can't apply all this. Then I will find out how much amount we will get on liquidation of assets and liabilities. So our focus now would be how much amount will be realized if the assets are sold and the liabilities are redeemed. Then what is the amount left for the shareholder? That is the liquidation value or the value of a non-going concern. So non-going concern is also called liquidation value. That means how much amount you will realize on disposing the assets and discharging all the liabilities. We have discussed this method of valuation in another chapter called valuation of share, where one of the methods was liquidation value of assets and liabilities method. And how do I compute liquidation value per share? Very simple. You will make a list of all the assets that you are going to sell, you can sell, and how much amount you are going to realize by liquidating all the assets. Deduct amount that will be paid to all the creditors and preference shareholder also. creditor and preference shareholder also, because I am valuing equity share. So amount that will be paid to creditors, preference shareholder, debenture holder, everything that you have to pay will be deducted, and then you divide by number of outstanding equity share, and that gives you the value of the share using liquidation value approach. This method is to be applied if the company is assumed to be a non-going concern. If the company is assumed to be a non-going concern, then this method is applied only to check the minimum consideration. For a going concern entity, this method is applied to find the minimum valuation. If you are selling your business as a going concern, it should be at least equal to the value of the asset that you are going to realize and the liabilities you are going to settle. Actual negotiation will be at a much higher amount if it is a going concern, because you will also take into account the goodwill and other intangible benefits associated with a business. You will take into account the earnings and the growth potential of the company. But in liquidation value, this is my final value. In liquidation value, this is my final value, this is what I will get. Going concern, this method can be applied just to find out minimum value. Which value will be lower? Going concern value will be lower or non-going concern value will be lower? Option A, going concern value will be lower. Option B, non-going concern value will be lower. Tick the right option. Whose value will be lower? If you are valuing a business, value of the business as a going concern will be lower or non-going concern will be lower? Your answer is right. The students are very active. I think they are enjoying this topic. So non-going concern value is going to be lower. If it is a going concern, you will have brand value, goodwill, lot of intangible assets which don't appear in the balance sheet, but it is important for business, like customer relationship or supplier relationship, trained employees, skilled employees. So all these have a value. They may not appear in the balance sheet. Customer list is there. So therefore liquidation value is lower than going concern value. Liquidation has some negative aspects also. Liquidation may result into laying off the employees, so you may have to pay VRS to them or separation benefits to them. Some compensation will be paid if the employees or the others are asked to leave the organization because the company is liquidating. Liquidation creates a bad feeling also. Oh my God, if a company is going to get liquidated, how do we feel about the company? Do I feel positive about the company or do I have negative views about the companies? So how do you feel about Kingfisher Airline? What kind of vibes are you getting after hearing this name? Kingfisher Airways, Jet Airways, okay, Go First Airways. Coincidentally, all of them are airways for all the mismanagement that has happened in these companies, right? So this creates a bad feeling and you don't find easily a buyer for such companies or investor for such companies. So that is having another side effect. Valuation based on non-going concern should be applied only when investors are of the view that the firm has no longer value as a going concern. If the investors think now this firm cannot be revived, it cannot continue, but still they might be willing to pay the price for that company because there are assets, which, like for example, a company may have land or a building which can be used by the acquirer, and therefore he will apply liquidation value. He will think, even if the company is wound up, don't worry, I will get this land, I'll get this building, I'll get this plant and machinery which I can use the way I want. So that is why he will be willing to pay only for the value of the assets, and if any liability is to be paid, he will pay for that. Why going concern value is higher? I have tried to make the presentation interesting in the form of asking you the questions. Why going concern value is higher than non-going concern? Why going concern value is higher? Because in case of going concern, you not only have the assets in place which will be used for doing business, going concern value takes into account the fact that this firm will continue, there will be future profitability, there is goodwill to the firm, and there are lot of intangible assets in the firm. Like for example, there is a customer relationship which is very important in business, that there is a supplier relationship. It takes many years to create a good supplier relationship. Then you have customer data, customer list, you have trained employees, skilled employees, then there is a process already set, right? There are other infrastructure available. It takes lot of time, efforts to create a business, to assemble so many things required in business. Everything is in place. The buyer has to only run the show, and therefore a going concern commands a much higher value than a non-going concern. So in case if you are interested, you can note down why going concern value is higher. The answer is printed in the book, but I was explaining that a going concern have got lot of intangible asset. They may or may not be appearing in the books of account, like brands, okay, technology. Many of these assets will not be realized if the business is wound up, because skilled employee will go away, customers will go away. But if it's a going concern, there is a value to that. So that is why going concern value is higher. Since an ongoing firm could continue to earn the profit which contributes to its value in addition to liquidation value, the going concern value is known as total value. So going concern value is called total value, and it is greater than liquidation value, because there are many intangible assets in a going concern. There is a future profit potential, so going concern value is higher. Now we will discuss valuation of distressed company. Everything is written in the note. If something is to be written, then I will tell you. You will find all this written in our notes or in the institute's notes also. Okay. Maybe some editing I have done while making presentation for a smooth understanding. Don't worry, it's there in the notes. Maybe some paragraph below. What is distressed company? What is distressed company? Like for example, bring before your eyes company like Jet Airways or Go First Airline, Go First, and such companies which are into severe crisis. what do you find? You find that there are certain common features in this distressed company, like revenue is declining, profit is declining, loss is increasing. They are not able to pay the debt. They have defaulted on debt. They are not paying interest on time. They are not paying principal amount of time. They are defaulting on payment of salaries to their employees. They are defaulting on payment of taxes to the government. Okay. Such companies are under distress. Some of them have negative net worth also, and they are close to being bankrupt. They are close to being bankrupt. Then it is called distress company. Company is in deep shit. Company is in deep trouble. Okay. And there is no ray of hope. At least in general, there is no ray of hope that this can be survived. That is how distressed company is defined. So now I'll read from your book. In the exam, the question can be a theory question. What are distressed companies? Distressed companies are businesses that are likely to or have already defaulted on their debts. Wow! A distressed firm generally have negative and declining revenue, and hence they are expected to lose money in future. For such firm, estimating cash flow is very difficult because there is a high risk of bankruptcy. You will only answer, can I apply discounted cash flow model for distressed company? Most of the things you would know already. Can I apply discounted cash flow method for distressed company? Option A, yes. Option B, no. Option A, option B, yes or no. The answer is no, because this distressed companies, they don't have positive cash flow, and we don't know whether they will ever be able to generate positive cash flow. Therefore, DCF model usually will not be applied. DCF model usually will not be applied. I won't say never be applied, but usually not applied, because if you apply DCF model and if cash flows of all future year are negative only, the valuation will become negative. So usual methods will not be applied. So let us see how we can value distressed company. First of all, you need to identify the reasons for the distress. Theory question. Your institute can ask anything, right? So you be prepared from different angles, at least whatever is there in the study material. First reason for distress is some companies are over enthusiastic and they may think that one day they will become Elon Musk, they will become Mukesh Ambani, they will become Bill Gates, and they borrow money, they keep on borrowing money, they keep on taking risk, they keep on increasing their business empire. But then what happens? Too much of debt results into too much of risk also, and therefore there is a possibility that you will not be able to repay your debt, you will not be able to pay interest on time, you will not be able to meet your obligations on time, and therefore you are going to run the risk of becoming a bankrupt organization, or you will be liquidated, or you need to reorganize your entire business structure. That is the reason for distress. Too much of debt. In short, you can write here too much of debt and all those associated problems which come with the debt. Another same point continues here. Reason for distress is inability to meet your operating expenses also. So you may have a very high fixed cost. So you have hired a lot of employees, you have taken places on rent, and now you are not able to meet those operating expenses, and that reason can be because your revenue is declining. If your revenue is declining, you don't have enough cash to meet your expenses. And the third is difficulty paying off its financial obligation to creditor, typically due to high fixed cost, illiquid asset, or revenue being sensitive to economic downturns. So business models are highly susceptible to economic cycles also, like we have seen, because now we have got examples of lockdown, which I hope you have seen that some businesses had more stress in lockdown, like for example airline businesses, because complete for more than a year the international travels were not happening. Or for example tourism business, for almost 1.5 to 2 years tourism sector was not operating because of the lockdown, because of the restriction, because of not getting international flights. Hotel business were getting affected. So economic slowdown may result into a sudden fall in the revenue, and because of that you are not able to meet your financial obligations. You are not able to pay the creditors, employees, rent, and such distress can lead to operational distress, such as increasing cost of borrowing takes a toll on the operations of the company as well. And then what do you do? If you don't have positive cash flow, what will you do? If you don't have positive cash flow, what will you do? You will borrow money. If you borrow money, again it will create more stress. So you will enter into a vicious circle. In order to meet your cash flow obligation, you borrow money, and again it gives rise to more distress situation. Now the student will ask me a question: does distress company have any value when revenue is negative? Or not negative, declining, EPS or earning may be negative, borrowing is very high, fresh funds are not coming or coming at a higher cost. Can anybody put a value on such distress company? That's an interesting question. So distress company does not mean zero value. Just because it is a distress company not able to pay the debt, that does not mean its value is zero. It's a wrong assumption. It may have assets. It may have assets. It may have a business model which may not be working right now, but maybe you can change the business model. You can curtail your scale of operation slightly. You can discontinue non-profit loss-making segments, and you can only concentrate on those few areas where you have profit, where cost is low, and then maybe you will have some values. So therefore there are distress company, but they still have some value. Distress company does not mean it is wound up. It is having difficulty. It is having difficulty and it is not able to pay the debts on time. Question is, can we apply DCF model? Can we apply DCF model for distress company? The answer is usually we don't apply DCF model for distress company. Or conventional methods, DCF model, earning capitalization model are usually not usefully employed, not usefully deployed when valuing distress company. Why? Because to apply DCF model, you need to have future cash flow. Even if cash flow is negative for few years, it's okay, but you must generate some positive cash flows in future. Some big bang positive cash flow even at a later stage is okay, so that I get a positive value here. But if your cash flows are continuously going to be negative, my value of the business will be negative. Business will have a negative value. So therefore, firms which are likely to fail, it has not failed, it is likely to fail. That means if something is not done urgently, then this business may be wound up. It will become a liquidation value in that case. Then we do not apply DCF. DCF is applied if the firm is expected to survive. DCF can be applied if the firm is expected to survive. DCF can be applied if the firm is able to generate positive cash flow. If there is any ray of hope, that the firm would be able to become cash positive in future year, then one can think of applying DCF model. Otherwise, DCF model, if applied when there is no hope of getting positive cash flows in future, it will give a negative value to the company. DCF model also requires you to calculate terminal value. Remember our business valuation chapter, first 5 or 6 year is called explicit forecast period, where we will compute free cash flow for individual year, and beyond that we assume that the free cash flow becomes stable or grow at a stable rate after the finite period, and we compute terminal value using the present value of free cash flow beyond the explicit forecast period. Now the problem is, it is a distressed firm. Can this distressed firm achieve a stable positive free cash flow after a certain time period? Can it achieve a stable positive free cash flow after a certain time period? The question is no, or not certain. And because we can't assume that cash flow will be stable after a certain period, it is difficult to apply DCF model for distressed company, because cash flows will be negative, and if cash flows are expected to be negative for a very long period of time, there is no ray of hope that cash flow will become positive. Then in that case, DCF model cannot be applied. What about discount rates? Discount rate we have learned. Discount rate cost of equity will be RF plus beta into RM minus RF. But even discount rate, like this formula, is applied for companies which are financially sound, stable. Okay, it takes into account the risk which may arise in general. But a distressed company is altogether a different story. There is no risk which will arise gradually or as a part of your business. Suddenly there is a loss. So therefore we don't apply conventional discount rate, or even if we take discount rate, we apply a very high discount rate. Because the risk is very high. The probability of such company failing is very high. The discount rate is also very high. The discount rate, if applied, would be very high. Now we'll discuss method of valuation of distressed company. There may be many methods, but our study material has given few methods. So we'll restrict to our study material only. Wait a minute. Something has gone into my eyes and it is troubling me. Okay. Method of valuation of distressed company. So for the time being, we will stick to our institute. methods they have given. If you are more interested, the world is open for you. You can do some research and you will find there are many more models for valuation of distressed companies, right? And one more thing is that our institute has not given any practical example or numerical example also. So that makes our task even more difficult, whether to enter into those practical example zones or not. The above mentioned reasons warrant adjustment or amendment and modification to be made to conventional method. That means conventional method cannot be used as it is. Conventional method assumes going concern, financially sound company, cash flow positive companies, or at least the cash flow will become positive after few years of operations, earning positive company, earning growing company. Those assumptions do not fit into distressed company, and therefore we are going to make some changes in the conventional method and do the valuation of a distressed company. So one method they have said, tick mark, on which we don't have numerical example, modified discounted cash flow method, modified DCF approach. So it is DCF approach only with some modification to take into account the probabilities that the company may not survive, to take into account the probability that company may be wound up, and therefore those probabilities will get introduced in the valuation method now. So I will stick to the institute. In future, if some numerical questions are asked, then we will take them separately. This method requires coming up with probability distribution for cash flows across all possible outcomes to estimate the expected cash flow in each period. So for each year, they are going to prepare probability distribution, like we discussed in some problem also, that this will be cash flow, this will be probabilities. They will visualize all possibilities that can be there and their probabilities. And based on that, they will compute the expected cash flow. Expected cash flow will be product of cash flow into probability, that we have done in other chapters also. While computing the cash flow, the likelihood of default should be adjusted for. And here is the additional change you have to do. You have to keep in mind the fact that these cash flows may not be realized. The company might default, right? In conjunction with this cash flow estimate, discount rates are also estimated. Because the risk is very high, the discount rate will also be adjusted. In case of distressed company, what happens? The debt keeps on increasing. Why debt keeps on increasing? Because in order to fund your cash flow, and if your operating cash flow is negative, you will have to borrow money. So your debt keeps on increasing, equity keeps on decreasing, because for a distressed company, the market price of the share will keep on falling, and the value of the equity will keep on falling. So what you have to do, you have to take the updated debt to equity ratio, every time you do the valuation, and you will use unlevered beta to estimate the cost of equity, using updated measure of default risk of the firm to estimate the cost of debt. Cost of debt will be high. Sir, why cost of debt will be high? Cost of debt will be very high because the risk of default is very high. Suppose you want to issue bond or debenture to raise money, then you will get yourself credit rated by a credit rating company like CRISIL, and this credit rating company will find that the risk of default is high. So will they give you credit rating near to AAA, or will you give credit rating near to C or D? Tell me which side credit rating will be there. This indicates on the one extreme highest safety, and this D is called junk bond. Risk of default is very high. So student will have to reply, for a distress firm, credit rating will be closer to C or D, or credit rating will be closer to AAA or AA? D. Very good. The answer is right. Now next question. If credit rating is D, interest rate will be very high or very low? Interest rate will be very high or very low? Interest rate will be very high. Wonderful answer. So my cost of debt will be very high and my average cost of capital will be very high. However, in the case of inability to estimate the entire distribution, probability of distress shall be estimated for each period and used as expected cash flow. So what is the formula they have given? Expected cash flow would be cash flow multiplied by 1 minus probability of distress. So this is the modification they have made in the DCF model. You will compute expected cash flow, but at the same time you are going to multiply by 1 minus probability of distress. Write down, it means cash flow into probability of survival. So cash flow will be adjusted. For a normal company, if the cash flow is 1000 rupees, we used to take 1000 rupees. But in case of distress company, if I think probability of survival is only 50%, I will adjust the cash flow and I will take 500 only. You can write this example. This is the maximum I can do for you. And this way you will compute cash flow multiply by probability of survival. Probability of survival is equal to 1 minus probability of distress. So cash flow will be adjusted, discount rate will be very high, and therefore this is called modified DCF. Cash flow is modified by multiplying by probability of survival. Discount rate is based on updated information about debt, equity, cost of debt, cost of equity, and that will be used for discounting purpose. Is it right? So this is my first method called modified DCF method. And in second method, what they are doing, they are asking you to apply a weighted average of two valuation, a weighted average of DCF valuation and distressed valuation. DCF valuation assuming firm will survive, and distress value assuming that firm will not be able to survive. Is it right? So now the valuer will assume two things. One assumption, the firm may survive, then it will be valued as a going concern. Okay. DCF valuation will understate the value of the firm if there is a possibility that firm will fail before it reaches the stable growth, and the assets will be sold for a value less than the present value of the expected cash flow. So DCF model and distressed value both will be considered. Now how do I do it? First I will think that the value of the business will be going concern. don't think that the firm which is under distress cannot be revived. A distressed firm can be revived. So first assumption is that it can be revived, and if it can be revived, it will continue as a going concern, and we'll do the valuation like a normal DCF model, subject to we are going to multiply by the probability of survival. Subject to we are going to multiply by the probability of survival. And second is we are going to also assume firm may not survive. Firm may not survive, and therefore what will be the amount we will realize if the firm is not able to survive. So that is called estimating distress sale value. Distress sale value means the firm will not survive and you will have to sell the business in distress to somebody. This will be provided to you, and as per the theory, the distress value can be some percentage of book value. For example, in balance sheet, asset, liability and shareholder fund is appearing. So asset minus liability, book value is 1000 crore. The firm is in distress, only 80% can be realized. So distress value will become 800. Sometime they may give you distress value is equal to 20% of DCF value. 20% of DCF value. In that case, you will take distress value as 20% of DCF value calculated above. So according to the question, you have to solve. So how do I compute the value of the firm using DCF valuation plus distress value? DCF value of equity I will find into 1 minus probability of distress. Find the value of equity multiplied by 1 minus probability of distress. So if you want, you can write here, it is probability of survival. Probability of survival. And then you will compute distress sale value. That means business is not going to survive. It will be sold at a distress sale. Then you will take distress sale value of equity into probability of distress. Into probability of distress. Now I will give you some notes here. Please write. DCF value of equity. DCF value of equity, how will you find? So first you will compute free cash flow to the firm. Free cash flow to the firm will be NOPAT minus net investment. NOPAT minus net investment. Compute the free cash flow, NOPAT minus net investment. Compute WACC. You will get value of the firm. Step 1 divide by step 2. You will get value of the firm. To that you add cash and other non-operating asset. You may have some assets which are not used for business, like investment, like some land. That will give you value of business. Step 3 plus step 4, and you deduct borrowing. You will get DCF value of equity. Please write in the notebook, because if they ask you, you should be able to solve. I am not explaining FCFF again. one full chapter we have done, FCFF. Probability of distress. What is the chance that the firm will not be able to survive? And 1 minus probability of distress is that the probability firm may survive. Probability that firm may survive. Have you noted? Have you noted? Now right below, this was point A, point B, distress sale value. Distress sale value will be equal to a certain percentage of book value or a certain percentage of DCF value of equity which will be provided to you in the problem. What is the percentage? And accordingly you will solve. So these are the two methods we have discussed. There may be other methods also, but not in the scope of our work right now. Is it right? Although I have written, what is written appears to be simple, but in distress form, estimating NOPAT is very difficult. Estimating net investment will be very difficult. Estimating this WACC will again be very difficult because the cost of debt will keep on increasing. Okay, so that is how you will apply the model. Now we'll come to next, valuation of startups. Very interesting area of this chapter. It could have been made more interesting by adding lot of numerical examples, but for the time being they have not done. Let us see in future what additions will be made in this chapter. So I will come to valuation of startup. Before that, first let us recall what are the generally accepted valuation models. Generally accepted valuation model, we have applied this in the chapter business valuation, is earning or cash flow approach, where we used to use multiples, or we used to use discounted cash flow techniques. So estimated cash flow for the foreseeable future are discounted to the present value and the value of the business is calculated. So this is our FCFF approach, FCFE approach, capitalization of earning approach. These are traditional methods generally used for stable businesses, growing businesses, but not for the startups. Okay, because startups may not have cash flow only for many years. Startups may not have profit also for many years. These companies like Flipkart, established more than 10 years ago, are still into losses. Companies like Paytm are still into losses. So therefore, difficult to apply this approach in case of startup companies, because there is no profit or cash flow for many years to come. And then asset approach. Under asset approach, what we do? We take the assets minus liabilities divided by number of shares. That is also an approach used. At least it gives you a minimum value the seller must ask the buyer to pay. So this sets like a minimum benchmark, mostly used for valuation at the time of liquidation. And then the model which is highly used is market approach, where comparable company or company in similar industry, they are used as base or benchmark. Their parameters are used, their valuation is used, to find the value of another company, and here we apply basically multiples. We apply multiples. Like I will go to a comparable company, check what is P multiple. I'll go to a comparable company, check what is sales multiple, what is book value multiple, what is EBITDA multiple. That is market approach. This model is applied to some extent in case of valuation of startups. These two models are not applied, usually not applied, because startups may not have positive cash flow for many more years to come, and we don't know whether it will be positive or not. Same thing about earnings also. If you look around you, so many startup companies, your Baiju also loss making for years, or that Unacademy loss making for years, or this Swiggy loss making for years, Paytm loss making, or even if now they've started, some of these startups have started making profit now, but very minimum compared to the amount of capital that has been invested. Most of the startups do not have enough assets. They work on rented premise. They take assets on lease. So there is nothing much like assets for them. They might have some intellectual properties. Okay. But yes, we can use a comparable company approach if applicable for startups. Why startup valuation is necessary? Lot of new companies, new business ideas are coming. So one person, okay, he is a young, qualified professional. He has got business idea. Some idea which is different from traditional businesses. So he wants to raise funds. There are people, investor, he is investor. They are also looking for investing their money where they will earn high profit. So they will shake hand. Okay. And the question will arise, how much amount the investor will pay to this company for a certain stake, because then you need to valuation. This person say my business is valued at 500 crore. Will the investor agree to that? The answer is no. So the investor will have to find out how to value that startup. How much amount I should pay for a certain stake in that company. So that is where the startup valuation becomes important. And the problem is there is no past data of this company. First thing, there is no past data. It's a new company. It has started business. It may not have started generating enough revenues also, or there are no similar companies also. It may be a unique idea. It is not tested in the market by other companies till now. Is it right? So that is another challenge. But still, we need to make payment. We need to invest in that startup company. So we need to do the valuation. What are the roadblocks with startup valuation? Challenges. You can visualize yourself also. You can give me few answers. I want to check whether the student can think what challenges you will face in applying valuation models for startup companies. Student will try few answers. Come on. What challenges do you think you might face if you are valuing a startup companies? I have already given you some hint. Please reply. What are the challenges, roadblocks with startup valuation? Any answer, please? Any answer? Waiting for you to reply at least few answers. Yes, one is market. We don't know what will be the market size. We don't know what will be the market size. If it is a new business model, we don't know what will be the market size. Okay. So we are not sure whether the product will be accepted or not by mass customers. So some examples we have written in the book. This list is not exhaustive, but yes. First is difficult to assume that their cash flow will remain constant. Difficult to assume that their cash flow will remain constant. Normally in valuation model, we assume year 1, year 2, year 3, and then after that we take constant cash flow or stable cash flow beyond 3 to 5 years. But in case of startup companies, I don't know, can we reach stable cash flow stage, and when we are going to reach that stable cash flow stage? I think the more difficult task is whether it will generate cash flow positive or not. That is also one challenge, whether it will generate positive cash flow or not. How much cash flow will be generated? Another challenge is, in order to valuation, I need profit. Profit, cash flows are the basic requirements of valuation, or maybe in some cases assets. Otherwise, why you are paying? Why you are paying? Why you are investing in a business if you don't have profit, if you don't have cash flow? These are the basic valuation drivers of any business, but there is no profit. The third is, sometimes I use the past profit to make projection about future. Capitalization of past profit method we have learned in previous chapter. But this is a startup. It doesn't have historical data. How do I make projection? Oh my God. Next is, the valuation to a large extent depends on future growth potential. Why startups are getting so much valuation is because they are projecting that in future the growth will be very high. They will generate huge amount of cash, right? But that is all about future growth projection, and future is dash 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 uncertain, which in many cases is based on untested idea and may not have been based on adequate sampling of consumer behavior or anticipated consumer behavior. So these are more about the idea. So the founder of the startup company, they always believe my product is going to be a disruptor. My product is going to kill the market and I am going to rule the market. Customers are going to use my product and we'll have a huge market potential. We have a huge market where we can sell the product. Every founder thinks like that, and that cannot be the basis for valuation. Many times they don't do enough customer research also. They may ask only few hundred people whether you will like this product, whether you will like this idea. A few hundred people opinion may not be the correct assessment. Okay, customer behavior can also change. By the time your product may be launched, the customer reaction, behavior, taste, fashion can change, and then it may not work. And then the absence of past performance indicators. This point is similar to this only. You don't have enough past performance indicator to make projections about future. Therefore, the valuation of startup is very critical, not so easy. Compared to a stable business, valuation of startup is going to be a challenge because of lack of historical data, lack of past performance, lack of comparable data, lack of you can say enough research being done on the success of that project. It is more about an idea, and we don't know to what extent the idea would be successful in future. Therefore, it is important to take the help of the professionals. The professionals have got expertise, experience in dealing with the startup companies, and then they might help you in getting your company valued. So startups founders are supposed to take the help of the professionals who are good in valuation, who have got a lot of experience in valuation, and they will properly guide you how much valuation the startup should command. Next question, why traditional method cannot be applied for startups? Already discussed in the roadblocks part. Traditional methods are capitalization of past earning, which we did in the earlier chapter, or capitalization of future maintainable profit, or DCF model, which requires you to compute present value of free cash flow to the firm or free cash flow to the equity, or you can apply relative valuation model, find a comparable company, and using the comparable company parameters and make some adjustment, you will value a particular given company. But in this traditional method will not work for a startup. There is no past profit. It's a new company. We don't know whether this company will be able to achieve a positive profit, when and how much profit, etc. So a lot of complexities are involved. The statistics says more than 50% startups, more than 50%, big number, they are not able to survive. They are not able to survive. So after initial business they start, they burn money. They call in this business or startup lingo burning cash. They burn a lot of cash, and once all cash is exhausted and the new funding doesn't come, which is called funding winter. Funding winter means new funds don't come up. Now new investors don't put money in your company. They have understood that this company does not have any future anymore. So there is no funding and this dies. So if I look at globally, not just India, globally, more than 50% startups, they don't survive. That is the statistics. You can do some Google search and check it. Right. Therefore, we don't know about future, we don't know about cash flow, and there is no comparable company also in many cases. Many startup companies have unique ideas which have not been tested, untried, untested idea, and therefore finding a comparable company is also difficult in cases, right? And if of course comparable company is available, you can use it. If you have to value Ola, there is a comparable company Uber. If you have to value Flipkart, there is a comparable company Amazon, which is listed on US stock exchange. You can compare like that, right? So sometime you may have comparable, sometime you may not, and then the traditional approach will not work. Traditional method assumes there is a established business. Under traditional method, what we are doing? We are assuming there is a established business. It is a profitable business. It has established set of competitors and it is generating cash. So what we have discussed in the earlier chapter, if you remember, we were assuming it's a cash positive company, profit making company, it has comparable companies, and based on that we have done the valuation. Look at these three statements and think about a startup. No profit, no established competitors also, and they don't generate cash. So therefore, the ingredient I require for valuation, these are the ingredient, the input for the valuation is missing. OMG, oh my God, this is missing in the new age startup whose value lie majorly in the concept. They have come out with an idea and potential rather than numbers with a track record. They don't have numbers, they have idea only. Okay, so they will come out with some idea, but I don't know at this stage whether this idea will really be successful enough to generate profit and cash flows. Lot of ideas come. Tell me, do you watch that program called Shark Tank? Just quickly reply yes or no. Shark Tank. I am not brand ambassador of this program, but yes, if you have seen, you will see every week whenever that program comes, every week there are 10-20 contestants who come and they come out with lot of wonderful ideas. But after 5 to 10 years, when you go and check, are they still surviving? You will find that no, more than 50% of them don't survive. They are only dependent on the idea, and idea may or may not work, because what the founder thinks, market may not think like that. Market may not think like that. What the founder may think, the market may not think like that, right? And therefore the idea may or may not be successful. Projecting profit, projecting cash flow is difficult. So now we have made a list of why traditional method will not work for startup. Theory question for you in the exam: why traditional method will not work for startup? Traditional method number one is income approach. Income approach means we have to estimate the profit of the company, future cash flow of the company, and in case of profit we apply capitalization rate, get the value. In case of cash flow, we compute the free cash flow, we apply the discount rate, we arrive at present value. That is income approach. Can we apply this to the startup company? The answer is difficult to apply income approach, because most of the startups are not generating positive cash flow in the foreseeable future. You can go and check today. One of the very popular startup company in India was Paytm. From the incorporation till date, the date when we are talking today, what is their cash flow? Is it positive or is it negative? Even though it has got listed also, interesting, with negative cash flow, it got listed also, and after listing also it is still having negative cash flow. How do I apply the income approach to such models? The cash flow is negative, profit is negative, but then the world is changing and there are investors who are still betting on such business model, because they think that one day, when that day will come, I don't know, but one day this business will become very successful and the cash flow in the later part will be so high that whatever losses you have suffered here will all be recovered. That is what the new generation investor community think, and they are still betting on such companies. Okay, because you don't have positive cash flow, it is not easy to value business by applying income approach. Can I apply asset approach? Can I apply asset based approach? That is the question. The answer is even asset based approach will not work. Asset based approach will also not work. So why it will not work? Because startups have negligible assets. These startups have office which are rented. They never invest in the office. They don't purchase the offices, they don't purchase the whatever factory that require or the infrastructure that require. All their equipments are rented. Equipments are on lease. Machines are on lease. Computers are on lease. Some of them work from co-sharing spaces also, where you are provided a space, you go there, work there, come back home. So that is not yours. You don't have any asset. You are operating from co-work places. You are operating from rented premises. Your assets are all leased out. So what you have only, probably, if you have got some intellectual property right, and if you have got it patented or copyrighted or trademark, that is the asset that you may have. Okay, IPR, intellectual property rights. If you have some idea and if you have got the copyright, patent, trademark, something like that, then that is the only asset you have. A large chunk of their assets are in the form of intellectual property rights and other intangible assets. So they have generally patents or copyrights or trademark rights. Again, many of them, they don't get them registered also. I have talked to so many people, they ask me the question, oh, copyright is to be registered? Such a useless question. Copyright, if you don't register, anybody can copy. You will work hard and your product can be easily copied, your model can be easily copied. So the first thing the startup companies should do, all their intellectual property and other intangible asset, they should get legal rights so that they can't be copied by others easily, because all your efforts will be a waste if somebody easily copies it. So they have to get their designs patented. They have to get their drawings patented. Okay, whatever. I cannot write a complete list, but if you are a startup company with some idea, and if that idea needs some legal protection, then you have to get it done. Otherwise, your idea can be easily copied. And that is the only asset you have. And at the beginning, nobody will give you damn value for these value assets also, unless somebody finds really that this is going to generate a good amount of profit. Then, because you have got these intangible assets, valuing them is also a challenging affair. Valuing such intangible asset is also a challenging affair, because many of them may be unique. There is no past data, past history for that, and they are yet to be tested in the market. Arriving at a consensus with the investor is even more difficult. The investor and the founder of the startup, they will usually not agree on valuation. The founder wants more, the investor wants to pay less. So that is why I said, if you look at that Shark Tank, which gives you a rough idea about how startups are valued, the founder member comes, he gives a very good presentation and he says, my ask is 100 crore rupees for 10% share. That means you pay me 100 crore, I give you 10% share in the company. And one of the shark says, I will pay you 20 crore for 20% share. Have you seen some such bargaining happening there? Yes. So there is a huge difference in the valuation. He is asking you 100 crore for 10%. So according to the founder, the valuation is 1000 crore. And according to the investor, 20 crore by 20%, the valuation is 100 crore. So that is the gap between the two valuation. Startups are new, but usually operate under the going concern assumption, and hence their valuation should not be limited to the realizable value of the asset only. Again, a good observation is, I am valuing a startup company, I am not valuing a liquidation company which is about to be liquidated. So therefore, I should not value a startup based on asset. Very simple, because startup company valuation is more influenced by their future profitability, future cash flow, rather than by their assets. So hence asset method cannot be used. What about market approach, comparable company approach, or using valuation multiples? Again, there is a problem here. These new age startup companies are disruptors. Disruptors means they completely change the way the businesses were being done. That is called disruption. Like for example, all of you might have used Ola, Uber service. They are disruptors. Now you don't have to go and search for an auto or a taxi, or you don't have to struggle to find auto or taxi. They have made an app and you can easily book it. But in India, there is no listed company like Ola or Uber. There is no listed company. Okay, so this is the disruption. This is the disruption in the market, and therefore there are no established competitor against whom you can benchmark. There are no established competitor. Otherwise, you know that for this competition, this is the value. If you are going to start, say for example, a banking company, you want to start a banking business, you have so many banks in India, and you can check which bank is similar to you. So you have ICICI Bank, HDFC Bank, you have Punjab National Bank, you have Bank of Baroda, you have Canara Bank, and you have a whole bouquet of banks, and you can benchmark. But if you start company like Ola, there is no established competitor. Or for example, that company, what we call it, like for example Flipkart also, we don't have too many competitors like this, Flipkart or Amazon. Okay, competition is from other startup only. Interesting point. One startup may be competing against another startup, and both are new, both do not have past track record. So how do I compare? The lack of established competitor indicate that their numbers may be skewed and may not be comparable enough to form a base. Very correct observation. If you don't have competitors, comparable company, we really don't know whatever numbers they are projecting, is it Is it appropriate? Is it high? Is it low? And therefore we can't make a proper base for valuation. Market approach is used for valuing new a startup, especially during advanced funding round. So market approach is used not at the beginning, but when already businesses have started, some round of funding have already been done. After that, maybe they can apply market approach also. At least some degree of maturity has been arrived at, or many round of funding have happened, and then maybe you can use market approach for the startup companies. Now very important paragraph is for a theory question also in the exam, and for your knowledge also, because after qualifying next few months you may join a company which is into valuation. Now there are many companies which do valuation for startup companies, and as a CA candidate or a professional candidate, you can join such companies and you may have to do the valuation of startup. Every startup has some unique feature. They are not comparable. What factors influence the valuation of startup companies? There cannot be one answer to that question. Every startup is different, every startup is unique, every startup has a different business model. Okay, a minute. Every startup may have a different business model, different technology, different customer base, different type of founders, and therefore we need to understand what factors influence the valuation of startups. I will first read the list and then we'll discuss them one by one. The most important thing, the most important in any business is the product or the service you are offering. Okay, then management team is important, traction we'll discuss one by one, revenue, industry attractiveness, demand supply gap, and competitiveness. These are some of the, this list cannot be exhaustive, some of the factors affecting the value for the startup companies. Like if suppose you are sitting as an investor and somebody comes and pitches his idea that, see, this is my idea, this is the product I am going to sell, then you have to check certain things about that product. Okay, then you have to check certain thing about that product and check whether that product is unique or not. In case of startup companies, the product has to be unique. You have to come out with some unique idea, and readiness of the product or service offered by significantly impact the company's valuation. When you go for raising funds as a entrepreneur, if your product is ready, which can be demonstrated to the investor, then the chances of getting high valuation is more. If you only talk the concept of a product and which is not yet ready, then probably the valuation can be affected, because the investor wants to see, touch, feel the asset. Okay, so somebody will say, sir, I have made this hybrid product, and this coffee hybrid seed I have used for making coffee, and this is one of the best coffees you will ever have. Then the investor will say, okay, please offer me some coffee, I will check is it really good or not. So you come out with lot of such ideas, you make some product, they want to see, touch, feel. If it is ready, good. If it is unique, good. A company that is ready with a fully functional product or offering will attract higher valuation. That is true. If you are only going to explain the concept of a product to an investor, he will not be interested. If you give the demo of the product to the investor, then he is interested. So your product, if ready, it is easy to sell your idea. If your product is ready, then it is easy to sell your idea, and probably if the investor likes your product, he may immediately be interested in investing in your company. Further, market testing and customer responses are key sub driver to gauge how the product is. And the next thing you have to do, you have to also do the test marketing. That means you should offer that customer to 1000 people, 500 people, and check their opinion, right? You can give free samples to certain people, and you have to see how many of those free samples have been given positive review or negative review, and accordingly the valuation is decided. So when you go to the investor, they will ask you, have you done the test marketing, what was the result of the test marketing, and all this thing about your product. Next thing which can affect the valuation is the management team. Who are the people who are going to manage this startup? What are their experiences? What is their background? What is their educational qualification? In which line of field they have worked in the past? Do they know their business well? Does the management team comprise of people from different areas like production, marketing, finance? Because only engineers cannot be good enough for a business. A good business requires, of course, somebody with the domain knowledge of the product, but then they also require somebody good with numbers, a finance guy, somebody who is good with marketing also, who can really take your products to the market and make the product likable by the customers, reach the customers. So nowadays management means you have to have all sets of people required for running a business. So that can affect the valuation. Now your institute says it has been observed that many startups were founded by people from IITs, IIMs, okay, but that is not necessarily the case. That is not necessarily the case. Somebody with a business idea, even CAs are nowadays, they are coming out with lot of ideas and they are running the businesses. Only thing is that management team should have profile of different type of professionals, like as I said, it should have engineer. If there are technology involved, it should have finance guy, because lot of financing in the initial stage is required, and there must be marketing people. Next is traction. Traction is finding whether what service or product you are going to offer is going to have a demand for it, because ultimately you have to sell, and to sell there must be a demand for that product. Your idea may be whatever unique, but somebody must use your idea, somebody must be interested in your idea, there must be customer who want that service. That is called traction. More the traction, more valuable the startup would be. That means if the demand for the product is going to be high, there are people who want that product, then the valuation will be high. So this investor will ask you such question that, do you think there is a market for your product, and what is the market size of your product? Fourth is, the more revenue stream, the more valuable the company. Ultimately what comes down to is whether you can generate enough revenue from this product or not. If the answer is yes, we can generate enough revenue from the product, then yes, this valuation will be high. You may not be generating revenue right now, but it should have a huge revenue potential in future. If the answer is yes, the product will be more valuable. And then industry attractiveness, whether this industry is liked by the investors, okay, whether this industry has got enough other resources to execute your idea. You may have one idea, but that may require other aspects also, like for example, it may require logistics, it may require distribution channel, it may require customer base, and therefore in addition to your idea, the industry in which you are going to operate should have other facilities also, and then it will work. For example, a new age startup in the tourism industry will be less valuable. You want to start something in tourism industry, okay, an innovative or unique offering it may be, but significant lockdowns are expected in the future. So industry attractiveness is less here, because you don't know what can happen in future. We have an experience of a long lockdown. Will it be repeated again? I don't know. Nobody knows what can happen. Is it right? The way the world is moving, uncertainty is very high, and again some new virus come, okay, although we hope it should never, but suppose it happens. As an investor, I have that problem in my mind, that doubt in my mind. What if I put money in this startup and again something like lockdown happens for 2 years, 1.5 years, even 6 months, it can result into complete close down of the business. So that industry may not be very attractive. So the industry in which you are going to work should be attractive. Okay, that is, the investor should feel comfortable about investing in that industry. And then demand supply. If there is going to be more demand for a product, then more investors are also interested. Try to enter into what they are saying, try to enter into a segment where the industry attractiveness is there, and because of that you will find more investor willing to put more money into your company. Like now I find lot of companies who are into doing research in pharma sector, they get lot of valuation. They get lot of valuation because there is an attraction. More and more complicated virus, disease, bacteria will keep coming up. We don't know, and we require more and more protection from such diseases. So companies who are doing research on this, they are getting more valuation because that industry is quite attractive. That was just an example. Now next point is, nobody likes competitor, because competitor can take away your market share. If competitor is very aggressive, he may completely kill your business only. So therefore, when you are going to when you are going to an investor to raise money, the investor will ask you one question which you will find every time they ask this question: who are your competitors? Who are your competitors? And if there are so many competitors with similar strength, then your valuation will be low, because then there is no attraction. You will not be able to generate a high return because of competition. So you have to find that kind of business model as a startup where the competition is less. Lower the competition, higher will be the value. And usually this investor look for business model which don't have competition. So you will have early start advantage. You have what is called first mover advantage in that business. Of course, you need to work hard to retain that advantage, but generally the one who enters into a particular product line or service, he gets a first mover advantage, and then it becomes easy for him to raise funds from the investor. For example, while it is easier to convince investor about a business which already exists, there is one advantage of competition also. The investor knows that business. He has heard about that business. He knows what kind of traction that other competition is getting. That is one advantage. Disadvantage is you have to face the competition and the market share gets divided. Like if you already have a competitor selling the similar product or service, it is easy to convince the investor. Ola company raised the funds, huge amount of funds, because they have shown the investor, see in USA Uber started and now Uber is a $1 billion company. Investor was convinced. India is a much bigger country, and in India people require taxi, auto, cab throughout the day. In India the public transportation system is not very good, not very efficient, so more people will use. It is easy to convince if you have a competitor who has successfully executed that model. Okay. One more example is a company called Airbnb, which provides you which is like hotel but not exactly hotel. You can book the room and you can go there, you can enjoy, come back. It is less like a hotel, more like, let's say, house given on rent for temporary period. And when in India also somebody started a similar model. Okay, Oyo rooms, easy to convince. This founder of Oyo, Ritesh Agarwal, nothing to do with me, not related to me, he is also Agarwal. He has proved that this Airbnb model is working successfully. So why not to replicate that in India also, where people are searching for low cost accommodation for short duration. Yes, it is easy. Long back, 30 years ago, 28 years ago, one Mr. Sabir Bhatia, he started one email called hotmail.com, and he wanted to provide hotmail.com as a free email service to everybody who wants to use email. That time, 25, 28, 30 years ago, there was nothing called email. Nobody knew email. Ask your parents. When they were in college or in their offices, when they joined, was there any email? No. Then Sabir Bhatia did not get funding only. For many years he did not get funding because there was no comparable company like that which is providing free email service. And finally he went to USA and some venture capitalist, they got the idea and they funded him. So you can understand from the difference of Ola and hotmail.com. Ola was able to demonstrate a competitor is their successful competitor. We can also replicate it in India, but for Sabir Bhatia there was no. But then Hotmail became one of the most popular emails at that time. Later on, of course, the idea gets copied and copied by Yahoo, Rediff, and now Gmail. It also cost an additional burden on the startup to differentiate itself from the competition. The investor will ask, if you have a competitor, how are you better than the competitor? What is the extra you are doing, additional thing you are doing, which makes your product unique? And if you can't prove that your product is unique from the competitor, the value will be low or you don't get the funding only. So now we'll take a small break, and after that we'll discuss some method of valuing the startup. So take a small break for 10 minutes and come back. Okay. Let us start again this amazing and wonderful topic. Now my next point is valuation of startup companies. Methods for valuing startup companies. Startup company valuation is always a challenge. We have discussed the challenges involved in valuation of startup companies, but still there are many innovative ways to value the startups. The purpose of all this method we are going to discuss is to reduce the subjectivity in the valuation of startups which have come in the recent time. So first you tick mark called the Burkus approach. And why it is called the Burkus approach? This method was given by an angel investor called Dave Burkus. He is an American venture capitalist. Burkus approach was given by Dave Burkus. He is an American venture capitalist and angel investor. That means he invests in the startup companies. He invests in highly risky companies. He provides capital to the new startup companies, and according to Burkus approach, it looks at the valuation of a startup company based on a detailed assessment of 5 key success factors. That means when you are going to value a startup, look at these 5 key success factors and value on that basis. That means you are not going to value the whole startup as one number, rather you are going to assign value for each of these 5 key success factor. You are going to assign value for each of these 5 key success factor. One is the basic value. The basic value is for your products. Then second factor is technology. The technology is path breaking, innovative, more value will be given. Success of a business depends on how successfully you can execute the idea. So execution will be considered. Then strategic relationship in its core market, strategic relationship with the customer, with the supplier, and then production and consequently sales. Production and sales. These are the 5 success factors in a business according to Dave Burkus, and the valuation will be based on how good these factors are, and accordingly you will assign valuation for each of these 5 success factors and take the total, and that becomes the valuation for the startup. Although in the classroom we don't have so much time, energy, effort, all these factors are analyzed in detail. They are going to check in detail each and every factor, what are the strengths, what are the weaknesses, and then they will quantify the value of each of these factors. So the important thing about this model is a detailed assessment will be carried out evaluating how much value the 5 critical success factors in quantitative measure add up to the total value of the enterprise. After doing detailed assessment, they are going to put monetary value for this 5 success factor, take the total of this 5 success factor will become the value of the startup company. Okay, so according to this method, it will cap pre-revenue valuation at $2 million. Pre-revenue valuation means before the startup generates revenue, before the startup starts generating revenue, and post revenue valuation at $2.5 million. So the limit is pre-revenue valuation $2 million, post revenue valuation $2.5 million. So if startup is generating revenue, then it is post revenue valuation 2.5. Startup is not yet started generating revenue, pre-revenue valuation should not be more than $2 million. Although it does not consider other market factors, the limited scope is useful for business looking for an uncomplicated tool. So you can say this model focuses on 5 success factors, but there can be other market factors also affecting valuation. However, this is a simplified model. What I have done, I have just created a small example for you. Please write down in the notebook. In the notebook, write down the name of the chapter first. Business Valuation Special Cases. Business Valuation Special Cases. Under that, write down next heading Startup Valuation. Next heading Startup Valuation. And under that again, next heading Burkus Approach. Burkus Approach. I will give you one small example. Write down please. You are investing in a technology startup. You are investing in a technology startup. You are investing in a technology startup. Use the Burkus method. Use the Burkus method. Use the Burkus method to estimate its valuation. Use the Burkus method to estimate its valuation. The 5 key elements typically assessed in the 5 key elements typically assessed in the Burkus method are the 5 key elements typically assessed in the Burkus method are. Then write down base value. Base value means assign a base value to the strength of the startup's idea or product. Assign a base value to the strength of the startup's idea or product. Let us say $4 lakh. Technology $2,50,000. Execution $7,50,000. Execution $7,50,000. Strategic relationships in core market $1 lakh. Strategic relationships in the core market $1 lakh. Production and consequent sales. Production and consequent sales $5 lakh. Production and consequent sales $5 lakh. Now write down the answer. So what will be the valuation of this startup using Burkus method? You just have to add the value assigned for each of the 5 success factors. So write down answer, sum of all these values equal to, just give me the total. Please give me the total of this 5 success factor value. Anybody who got the total? Answer is how much? Just check and confirm. Is it $20 lakh or $2 million? Is it $20 lakh? Yes. Okay. Now write down note, based on the Burkus method, the estimated pre-money valuation of the startup, the estimated pre-money value of the startup is $2 million. This is the value you should consider. This is the value you should consider when negotiating your investment in the company. This is the value you should consider when negotiating your investment in the company. When negotiating your investment in the company. So this was just a simplified example. as to how this Burkus approach operates. 5 success factor, do detailed evaluation, find out their value and add it up. That gives you the value of a startup company. This is Burkus approach. Next model is called cost to duplicate approach. Cost to duplicate approach means if this is a startup and I want to start a similar startup, how much will it cost to duplicate a similar startup business? How much would it cost to duplicate a similar startup business? Whatever cost they have incurred in technology, product development, okay, expense on employees, marketing, all those costs will be added up and that will give you the value of startup companies. This model is focused on cost incurred to create the startup and how much somebody else would incur to create a similar startup companies. But the problem is this model is not a very sound model for valuation. It takes into account the cost incurred in the past for creating a startup, but it is ignoring, as you have rightly understood, the future revenue projection of the startup, okay, or it does not focus on the assets of the startup. So therefore this model will undervalue a startup. This model can undervalue a startup. There is no numerical question on this, but in the exam the institute may give you some cost like product development cost, purchase of asset, expenses. What you need to do, you need to add all these costs and that will be the answer under cost to duplicate approach. Next model is called comparable transaction model. That means if a similar transaction has taken place in the past, then you can use that as a basis for the purpose of valuation. Is it right? Just for example, suppose there is an app, whatever is that app, and this app has got subscribers, let us say 1000 subscriber. It was recently valued for 50 lakh. This app was valued for 60 lakh. So the value per subscriber, because in case of something like apps, the value driver is subscriber, the value per subscriber, and that is why these companies which have got apps, they will insist you to download their app, download now, okay, because more the number of subscriber, more the valuation they will ask for. And now suppose your app, you have also developed a similar app, you have got 5000 subscriber, so your valuation will be 5000 subscriber, value per subscriber 5000, so that comes to 25 million or 2 crore 50 lakh. So that is how that comparable transaction method is used. In different business, you have to find what is the value driver and based on that the valuation can be applied. In case of let's say websites, they may use how many visitors are there, okay. In case of search engine, how many search took place in that website. So depending upon what is that business model, you can find the value driver. If a similar company has been valued using that value driver, you can apply in your firm also. So this is like applying comparable company approach only. This approach is lucrative for investor because it is built on precedent. So there is a past data of similar business. The question is, how much were similar startup valued at? So in the past, for example, there is a company XYZ, a logistic startup, was acquired for 560 crore and it had 24 crore active users. It has 24 crore active users. So 560 divided by 24, which means the valuation is 23 rupees per user. Let me check. This is institute example. So the answer is yes, 23.33. So 23 rupees per user was valued. Now there is another company ABC which is also into logistics startup and it has got 1.75 crore user into 1.75, 23 into 1.75, that is roughly 40 crore. So this company ABC will get a valuation of something around 40 crore. Is it right? So this is valuation game. I call it valuation game. And they are just trying to increase the value by adding more and more users. They will give them incentive, cashback, wallet, gift, dummy also data is inserted so that the number of users and subscribers go up and then they will get a huge valuation for that startup. With any comparison model, one needs to factor in ratios or multipliers for anything that is a differentiating factor. So when you are applying the comparable transaction approach, find out what is the important differentiating factor and based on that the value will be assigned. Example of important value drivers could be proprietary technologies. That means some technology over which you have only got patent, others can't copy. Then it depends on intangibles, industry penetration, locational advantage. These factors are also kept in mind while applying comparison approach, and depending on that the multiplier can be adjusted. In the previous example, we have not adjusted the multiplier. We simply took 23 multiplied by 1.75. One has to also take care of other differentiating factor and because of which the multiplier can be increased or decreased. And next model is called scorecard valuation model. Scorecard valuation model, write down important. Theory question. They can create a numerical question also on this. The scorecard method is another option for pre-revenue business. This model can also be applied to value a startup in the initial stage. Pre-revenue business means the startup has not yet generated revenue. It is in the very early stage. The startup is at a very early stage. Okay, like when we draw the life cycle of a product, somewhere it is here only at a very early stage. This is the stage of startups when they have just started their business, and this is the stage of distressed company which we discussed. So we are right now valuing a company at this stage of their life cycle. It also works by comparing the startups to other already funded but with some added criteria. This model can be used by comparing our startup company with other startup companies which have got funding in the recent past. First, we find the average pre-money valuation of the comparable companies. First, we'll find average pre-money value. Now, what is pre-money value? suppose capital employed in a business is 400 and investor puts in 600, total 1000. This 1000 is called post money valuation and this 600 is called pre money valuation. That is the difference. Post money means after this amount is put. Pre money means before adding 400 with 600. This method can be used for early startup companies. This method can be used on the basis of average pre-money valuation of comparable companies. And basically the idea is you have to compare a set of parameters of one company with other company and then see how much valuation other company had commanded, and based on that you are going to value a given company. That is how scorecard valuation works. So there will be different attributes of a startup and you will give scores for these attributes. Similarly, comparable company also has got scores for the attribute. If comparable company has got a value X for these attributes, how much value this particular startup should get for these attributes? Let us see what are these attributes. These attributes can be something like strength of the team, size of the opportunity, product or service, competitive environment, marketing, sales channel, partnerships, need for additional investment and others. And you can give them a weightage of, these are the weights. You can assign them a weight between 0 to 30%, 0 to 25%, 0 to 15%, 0 to 10%, 0 to 10%, 0 to 5%, 0 to 5%. These are the 7 attributes given. You will compute the value of each attribute of the startup. How do you value? If the strength of the team is more, you can assign more value. If the size of the opportunity is more, you can assign more value, right? And then you will take the weighted average. For example, we have to assign a value maybe in the range of 1 to 10. So if the strength of the team is good, I will assign a value of 9. If the size of opportunity is very good, maybe assign a weight of 8. Product is too good, 10. Competitive environment, too much of competition, weight value will be less. Marketing channel etc. is very good, higher value. Need for additional investment is more, lower value, and some other factors, let's say 8. Then you will multiply weight into value assigned, okay, and then you will get the scorecard. Scorecard will be weight into value. So you will get some value here, you will get some answer. Let us say you get, for example, only 6. So your company got a scorecard of 6. A competitor scorecard was 7. A competitor scorecard is 7, and this competitor got a valuation of, let's say, 7 lakh. If this competitor got a valuation of 7 lakh, then for 6 score you will get a valuation of 6 lakh. That is how scorecard valuation method will work. You will calculate scorecard for this startup. You will find out the scorecard of a comparable company which got valued recently. and see how much value was given to that other company, comparable company, for a particular scored card. So for 7 scored card, 7 lakh value, and you have 6 score, you will get 6 lakh. So that is what is explained below. I wish institute would have given a question also. So now the note says then we assign each quality a comparison percentage. You can give the value or the scores in percentage or in numbers. Essentially it can be at par, that is 100, it can be below average, less than 100, or it can be above average, more than 100 for each quality compared to competitors or the industry. For example, so you have to give the scorecard depending upon how good or how bad that particular quality is. After giving the value or the score, example, a marketing team has a 150% score because it is thoroughly trained and has tested a customer base that has positively responded. So you would multiply 10% by 150% to get a factor of 0.15. So in this example, the marketing team has got a score of 150%. It can be based on percentage or it can be based on a scale of 1 to 5, 1 to 10, and this will be done for each startup quality, and you will take the total. That will give you scorecard, total scorecard of that startup, and then this is multiplied by average valuation in the business sector. So after you get the scorecard, you apply the comparable company average valuation and you get a pre-revenue valuation. Is it right? I have created a small example on this. Please write down. I have created a small example on this. Please write. You are valuing a startup. You are valuing a startup. You are valuing a startup. You select the following key factors. You select the following key factors and assign weights to them. And assign weights to them. Under that, write down strength of the team 20%, strength of the team 20%, size of the opportunity 15%, size of the opportunity 15%, product or service 10%, product or service 10%, competitive environment 10%, competitive environment 10%, marketing, sales, channel and partnership, marketing, sales, channel and partnership 20%, need for additional investment 15%, need for additional investment we are giving a weightage of 15%. This I have just written, it has nothing to do with your study material. And others 10%. This is just illustration, it is not a law. Different companies or different investor can have their own weightage for different attributes. Okay, now write down, you score the target startup. You score the target startup on each of these factors. You score the target startup on each of these factors using a scale of 1 to 5, using a scale of 1 to 5, with 5 being the best score, with 5 being the best score. So you have already computed the scores And what are the scores for these 7 key factors? Right, strength of the team, you have given a score of 4. 1 is lowest, 5 is highest. 5 represent best, 0 or 1 is worst. Size of the opportunity 3. Size of the opportunity 3. Third line, product or service. These are the scores on a scale of 10. 3. Competitive environment 2. Marketing, sales channel and partnership 2. Marketing, sales channel and partnership 2. Need for additional investment 4. Others 4. This way you have to get the scores by evaluating these key factors of the startup companies. Like in your school, your teacher used to give grades for attendance, for sports, for academics, A, B, C, D. Now write down below, have you completed writing? Have you finished writing? I am just giving an illustration of how scorecard valuation method would work. Write down below example. So don't write this. Now write down below, this much we have written. Write down below average score. So what is your average score? Remember your school days, how teachers used to give grading in your mark sheet or report card. This is also report card of the company only. This is like a report card of a startup company. So can you tell me the average score? Start from here. This is already there. This was already there. Start from here. Average score. One student has correctly replied 3.14. Now what I'll do, I'll take a comparable startup company which have been valued recently. Comparable startup A has an average score of 3.29. Comparable startup A has an average score of, write down an average score of 3.29. An average score of 3.29. Next line, write down, assuming that comparable startup A raised $5 lakh. So a comparable startup raised $5 lakh when its score was 3.29. Therefore, average valuation of comparable startup A, its value is 5 lakh, score is 3.29. So you write 5 lakh divided by 3.29. 5 lakh divided by 3.29 is equal to 151,662 dollar per point. That means the average valuation in this business is $151,662 for 1 point scored. And now I will come back to this company which has a score of 3.14. So write down, therefore average valuation of target company is equal to $151,662 per point into the score. So in this industry, this is the average valuation per point, and this is the score of target company which I need to value. So the value to be assigned to our target company would be multiply, check the answer, multiply, check the answer, 476,219. Is the answer right? Is the answer right? Rounded off. Very good. So this was a small rough example on scorecard valuation model. If you are given average score of a comparable company and the valuation of a comparable company, you find the average score of the target company, and using that value per point you will find the value of the target company. So this gives you a rough idea about how scorecard valuation method will work. So today we'll stop here, we'll continue tomorrow. Thank you very much.